Hi, I'm Llanes with Wealthnet Investments and JP Tremblay with us.
Good morning, Louis.
Today we're going to be talking about the business cycle and investing in the late cycle. And we're just going to do a short video and we're going to knock out some of our thoughts about the business cycle, sectors, and maybe company characteristics that we think are working in this environment. So JP, give me a little bit of background why we think that the sector is towards the tail end. It seems obvious to most of us, but maybe just a little bit of backdrop about the economy and where we are.
Yeah, so when we think about the business cycle, so the real economy, I think we are in the late stage. I think we have all of the indication that we are there. Now, people can argue over, are we early, late stage, late stage? Are we already in a recession? This is not the point of this talk today to try to nail that, and that's proven to be very difficult. But we know that the Fed has started accommodating the economy, hopefully, thinking that the economy needed some help. And alongside of that, what we need to focus on our side when positioning portfolio is to determine what kind of drivers of profitability, what kind of asset classes will be favored at this particular time of it. I think what we have to look at is this is a time where it's especially challenging for investors, both professional and individuals, to remain disciplined and invested, because the market will tend to give you either the utmost confidence that everything is fine and we're headed for the sky and you don't want to be left behind. That's when people throw good money after bad and maybe the quality of decision making goes down. And other times you will have these shocks that make you believe that we're all going to, everything is going to hell and you want to run for the hills. So you do not want to succumb to these emotional times. So you have to give yourself a framework to look at what are you looking for, how do you remain invested in a disciplined fashion. What do you think?
Yeah, no, I agree with that. We just saw that this morning. We saw that yesterday. We see these little shakeouts. We had a basing action for a long time in the stock market. Then we had this big move up. And then we've had a couple of days of just these really quick downs. And that's kind of standard for what the market tends to do towards the late cycle. It gets really exuberant. When I think about the last business cycles in my career and your career, they can be very exuberant towards the tail end too. I mean, we saw the IPOs do very, very well. They kind of fell apart. We've seen that happen towards the tail end before. We saw defensive sectors move up, the utilities, the real estate investment trusts. We were looking at a chart earlier today of Cohen and Steers, which is also a manager in the real estate, which is doing well right now. Those are the kinds of things that we tend to see towards the end. But at the same time, we're seeing some of these companies with really strong revenue growth and really strong new products and services that are doing very well right now. And it seems to me like towards the tail end of the cycle, growth becomes more scarce and money starts focusing in more and more towards certain types of characteristics. So maybe we can just talk a little bit about sectors in terms of what you're seeing in that realm.
Yeah, so we've seen a definite change in leadership at the sector level. If we look at earlier this year versus this past quarter, let's say since September, we have seen a switch from the more cyclical stocks and sensitive areas, discretionary, IT, and some of the sectors that have been neglected, like healthcare and real estate and things like that, are now coming to life. So we are seeing definitely a rotation into sector leadership. And alongside of that, it's not a question of timing sectors, which that may be what it sounds like. It's about thinking about like you said, the characteristics of the underlying firms in those industries that may be well positioned and rewarded in this kind of environment. So you mentioned good growth. Now we're talking about top line growth. If we look at Q3's earnings, we'll take the S&P 500, you'll find that a lot of companies have done extremely well. So if you look on the surface, and what's usually being reported in the media is company met earnings, and we have a large portion, 80% of the S&P 500 companies beat their earnings estimate, and that sounds all nice and fine. If you were to focus on the top line, on revenue, now you're talking more of a split house. You're talking about more of a 50-50 split between companies that did meet that and not. So now you're like, okay, what are you looking for in this? I would argue that you're looking for companies that are able to grow in an environment that is potentially challenged from a growth perspective. So which companies is able to grow in this economy faster than the economy?
Well, we were just looking at Apple. I punched it up earlier. I mean, their revenue growth numbers don't look that great. I mean, we saw an acceleration. We're seeing an acceleration in the expectations in the next quarter. But if you look at it on a run rate, it's really not that great. I mean, the company is priced in such a way that you would think that they have like really, really amazing growth. But in actuality, they really have more like stability and quality of earnings, right? I mean, that's something that we were talking about in terms of characteristics. We would talk about the sectors. We don't time sectors. Mm-hmm. We just kind of look at it to say, okay, well, we just happen to notice that, we're more bottom up oriented. We just happen to notice that some of these sectors are tending to have thematic moves. Mm-hmm. But if we think about late cycle investing right now, what are the characteristics that you think make more sense to be looking at? I mean, we talked about recurring revenue.
Yeah, recurring revenue is one of them. High quality of earnings, which means, if we define it very simply, is how well are you doing converting those sales into earnings, and does your cash flow actually match your earnings, or is it based on some accounting trickery that allow you to recognize revenue or expenses in a way that's a little more creative, right? So we're looking for companies that are good cash businesses, cash generating businesses, mm-hmm. And we're looking for also a business model that is proven and stable. I like that you use Apple. Let's take Apple for an example. Apple is in a transition. It used to sell widgets, right? They used to sell us iPhones, and it was a quantity business, a unit business. I sell X amount of iPhones this year. Next year, I have to sell the same amount of iPhones, plus then some if I want to grow. That is tough when growth is not there in the economy. Now, Apple has successfully made the transition of a larger portion of their business to something that is recurring. Mm-hmm. So revenue that comes from either cloud businesses or subscription to Apple TV or Apple Music.
It's turning more into a growing annuity.
Exactly, and those
is it priced for that though? Is it priced for growing annuity type model, or is it still priced for massive
I think
growth?
It's in transition, and that's what we see. Those companies that have a large trail are a lot more valuable if you think about price earnings ratio than companies that are more transactional basis, which right now we're seeing a transition out of. And you want companies that are able to make money providing those services. That's mm-hmm. why you're seeing, you mentioned the IPOs of Uber and Lyft. I think the business model, these companies that still have not proven their ability to generate money, even though they can grow by leaps and bounds, mm-hmm. they still do not generate operating income that is positive. So as an investor, if I invest in thinking that a company is worth what it can generate in cash flow in the future, if we're not seeing cash flows, I would say maybe that's not something I want in my portfolio, even though I'm excited about the innovation and the disruption of that business.
My favorite companies are the ones that are showing the top line and they're just now starting to become profitable, because what happens is most institutional investors, you can see it in the institutional sponsorship, they're not looking at these companies because they're screening companies that have profits, and they're just not looking at them. And then as they move profitable, then all of a sudden the institutions start picking them up. And you can see that the best managers, the best small cap managers, mid cap managers will start taking 0.5% positions, 1% positions. And as they're building their position and it becomes known that this is a good company and they actually have a business model that's working, that the stocks double, triple, and quadruple in price. And we're seeing that happen with some companies in the biotech area, in technology, things like that. And that's where our dynamic growth strategy complements more of our fundamental core strategy, which is more, looking for those stalwarts. And I think one of the things I've noticed is that these, as the economy gets narrower and narrower in terms of growth, there's more money that is being focused in. It's like, where can we find that growth? And I think that's something that we need to continue to keep our eye on.
Exactly. And if we think about those pockets of value, I mean, we saw that value as a pure style has done a tremendous amount of a rally in the past quarter, even though people left it for dead, saying, okay, value is dead.
Value is not dead to us.
Value is not dead, but
right.
Maybe it's a question of the way you define value. I mean, I like to think of value not as the opposite of growth, but maybe as mispriced growth. Mm-hmm. So now we're looking at firm with characteristics that were neglected or not as exciting to the market that now are coming back to life, and we're seeing those characteristics. So the portfolio of tomorrow, the firms that are going to perform going forward, will probably be different than the ones that led us to this level of the market, right? So that's why you have to be a little more dynamic in the way you allocate assets to in a client's portfolio and to the themes and the characteristics of the firms in your portfolio.
Yeah, I agree with that. Let's talk a little bit about asset allocation now, because we've talked about the types of companies, recurring revenue, quality of earnings, things like that. But let's talk a little bit about asset classes during a tough time. What about bonds? I mean, we invested in the long bond, and nobody expected the bonds to do very well a year ago. And they've really done pretty well on the long end of the yield curve, right? Where's the role of asset classes, gold, bonds, other things, in a late cycle, from your perspective?
Yeah, I think it's been easy to forget about the benefit of diversification in a rip-roaring bull market with very low volatility. It was easy to say, there is no benefit to that. But this is when we need it, right? So you have to be allocated in things that will behave differently based on the different drivers, right? So bonds was one that we saw being kind of neglected and underpriced, even though you could have made an argument that the environment wasn't good for bonds. The market definitely also saw the same thing and picked them up because they were cheap. And when you're trying to allocate money away maybe from equity a little bit, peeling off the top, then where do you put it, right? Under the mattress is usually not an option for most
not
people.
A good idea.
No, exactly. So you're starting about bonds, and you go to maybe some protections like gold, a little bit of alternative asset classes. Real estate is more now an accepted equity asset class because now you can trade them on the REITs, but it used to be an alternative ones, which again tends to do well at this time of the cycle. In this case, because of they provide the yield that the market or the traditional bond does not give you for an investor. Right?
Just like recently, we're looking at we had this big move up. We were consolidating in stocks. We had a big move up, and as those stocks moved up, we saw that big bond move take off. Now we're in a consolidation. Gold is consolidating. Bonds are starting to test the top end of that range again. So as the stock market is kind of stuttering a little bit in the last couple of days, that's the kind of thing that I think is really, really important to have, is that diversification and that looking at the kind of the pulse and the waves of as these things happen and allocating accordingly. Some of these big chip stocks have had a huge move up, and now they're starting to pull off. And that's already been anticipated. Those are really cyclical type companies, and yes, they have some other types of kind of near-term things that are helping them out. But I think a lot of people are being lulled into this market thinking that everything is just fine. I want to talk a little bit, about, we were talking earlier about how when the markets are doing really, really well, we tend to get more money coming in, clients asking us to invest more money. Speak to a little bit of your feelings about how we protect clients' money right now, because we have, people have money to invest. What do we do now as the incremental new money is coming in? How do we protect that? How do we think about investing that?
Yeah, it's difficult if you've been around the market long enough, especially if you've been around the 2000 internet bubble, to not draw some parallel, even though I don't think anybody here is calling that we are in a bubble like we are. But what we're seeing is people chasing the market, right? You said, now it's time to get in. It's been going up for 10 years. Like, you're just deciding now that it's time to get in. So,
well, just last year during the holiday, during Christmas time, nobody wanted to be in, and that was a bottom, and now we're up significantly from that bottom.
Yeah,
so,
that December.
And now people are throwing money in.
Exactly. So that's why we have to remain disciplined in the way we look at investing, deploying new money, right? So while we certainly wouldn't be the one to say it's time to pull back, we also have to be cautious as to how do we to put new money to work. And what we propose here is kind of scaling in, but more from a new ideas. Again, the portfolios of yesterday may not be tomorrow's portfolio. So now we're trying to allocate to newer ideas and to more things that are appropriate for the current area of the place in the market cycle.
It's definitely tricky. It's definitely tricky dealing with that. How do you do it? Well, you could just put people in just your best ideas at that time, but many times they will underperform if you do that. You'll have too much cash drag. And one of the things that I found is that investors, I don't care what kind of investor, or traders, deep value investors who are so, just staunch about their value will tend to underperform because they're waiting for that perfect opportunity to hold too much cash. And then they sell too soon. Whereas technicians who follow momentum, they'll tend to do something similar, but in the opposite direction. They'll try to time it perfectly and then get out. And, we don't think that way, right? We think in terms of relative opportunity and diversification, right? And,
yeah, absolutely.
And keeping people invested in the long run, that helps our clients do better than if we try to be so precise with our timing. We want to look at the relative opportunities and make sure people are balanced in that portfolio.
Correct. And I don't want to give the wrong impression. I think we will deploy clients' money into their asset allocation, right? So the proper asset allocation for each client is determined, of course, on a case-by-case basis. But once you have that, this is your chassis, right? So we determine that we should have X percent of exposure to equity and X amount into fixed income. Now comes the more tactical aspect of that. So we will invest that money into those asset classes, and then maybe make some tactical decision, which is where we talk about, okay, what is the current opportunities in the bond area? And
we will scale out of the market. If the market looks rough, we will scale out of it.
Yeah.
And that's really, really important. And we both have a history of doing that for people. Of scaling them out of the markets when times are starting to get rocky, and to protect that capital. That is so important. And to be fully invested, and this is one of the things that not everybody will agree with, but if you're just a full-time indexer, everybody wants to index when the market's going really, really well. And as soon as the markets get really rough, all of a sudden you don't hear about those indexers anymore. They're not out there pounding the table about how great indexing is. And we are not an index shop. We don't believe in that. We're not saying it's bad, and we do buy indexes, in certain ways. But we generally don't think that all your capital should be deployed based on the market capitalization and the weight of that investment in the overall market. That makes no economic rational sense to us, other than the fact that it's a base case. And it is hard to beat an index when the market is rip-roaring, because it's fully invested, and it actually is a disciplined strategy of momentum, because you're buying more. You basically, it is a momentum strategy, and that's hard to beat. But over the long run, risk-adjusted returns are better for clients, especially when they have to generate income and do other things with their money, when we have more of a rational valuation, quality valuation, technical approach. So that's really, do you have any other final comments before we wrap this up?
No, I just, so we have to be forward-looking. Again, this is not to scare anybody. And at this stage of the market, I think the market may feel like it's out to get you. So remain disciplined and look forward more than backwards at this particular stage. I think look for what you believe are going to drive performance of firms and asset classes going forward. Position the portfolio adequately for that environment, and be patient. So,
Very good. Very good advice. Well, thanks for listening in. I hope you enjoyed it and got something out of it. Be sure to follow us on Twitter. Check us out at wealthnetinvest.com. Louis Llanes from Wealthnet signing off with JP Tremblay.
Have a good day. Thank you very much.
Bye for now.